Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcasts. For example, we recently interviewed the national presidents of some of the major real estate associations like BOMA, SIOR, and NAIOP to help you pick which association might benefit your business the most. Last week, we looked at the hot student housing market. There are lots of interesting shows to choose from. You can access them on your computer, tablet, or smartphone. Just visit iTunes or the show website, commercialrealestateshow.com. Well, today we're exploring the U.S. office market. Please welcome David Tennery, principal with the Office Properties and Development Group of Regent Partners. David has been involved in the development of more than 6 million square feet in the U.S. and Latin America. Since 1988, Regent has acquired and developed more than 10 million square feet, valued in excess of $2 billion. David, welcome back to the Commercial Real Estate Show.
Thank you, Michael. Always a lot of fun to be with you.
And David, we've heard from Walter Page with CoStar about the market overall, but as an industry participant, what are you seeing on the ground there with your office properties? And most of your properties are Class A assets, right?
That's true. Most are Class A, and most are relatively urban in nature and are of a mixed-use nature, led by office. And in that respect, I would say that our demand has been steady, really going back to probably the second quarter of 2011. And then if I look back at the previous 2 or 3 quarters, I'm happy to say that it has really been very steady to growth-oriented.
Okay, so are you seeing more demand now as people are getting a little more confidence in 2013 about the economy?
We are. We're seeing an increasing demand. We're seeing increase in rate for the most part in most major markets. And it's really pleasing to see that the demand we're seeing is broad sector. It's no longer just technology, no longer just professional services, but a very broad reach in terms of sector growth.
Okay. And now there are certain size tenants that you're seeing that growth, and have you seen, what is the trend you're seeing there? Is there one?
Great question. There really isn't one. I'm seeing deals come across the different markets and different projects that are 2,500 square foot tenants that are expanding by 10 to 15%, and 50 to 75,000 square foot tenants that are expanding by 10 to 15%. So again, not just broad sector, but broad size.
Okay. So are you seeing occupancy gains in your assets overall?
Yes, very much so, particularly, again, over the last 2 or 3 quarters. When we listen to what Walter had to say about occupancies, our portfolio is very consistent with what he's talking about on a national basis with respect to reduction in occupancy and vacancy factors. Okay.
And how's that affecting rate growth? Are you really seeing significant rate growth, or a little? Or?
Well, it depends by market, of course, but I would say that in all markets we're seeing rate growth, some greater than others. And then, of course, when you look at an overall market, just as we've seen a lot of in Dallas and Houston, and we're seeing this in Atlanta, I know this has been happening in Seattle for the last year plus, is that within the micro market you've seen growth, but on a macro basis there's been some pretty outstanding pockets as well in growth.
Okay. And David, at Regent Partners, you guys I know have acquired some nice assets lately. You're gaining ground in your occupancy. What are you doing to attract tenants? And are there any special things you're doing differently, or is it just doing what you do well?
That's a great question. I think we have focused on our core behaviors and qualities of tenant treatment, of customer service, of retention, modification behaviors that we've all had to learn to deal with in the last 10 years. But I would say more than anything, Michael, we are really working hard to demonstrate the stability we have as a long-term firm, long-term player, a quality player, and one that takes good care of the assets. Tenants have been through an awful lot of turmoil in the last 5 to 7 years, even in many cases where he had large institutional partner type ownerships where things have just not worked out. And so the ability to demonstrate performance and a history performance, no legacy issues, and provide the confidence with a tenant that they're going to be in good hands for some period of time has been very helpful to us.
Okay. And you're also tenant broker friendly, aren't you? I mean, tenant brokers can feel comfortable bringing a tenant to your buildings around the country, and they're going to be taken care of and treated right.
That's exactly the case. And we finished up a lease yesterday and are trying to finish one up this morning in the Atlanta markets, which are very sizable. And in both cases, both were brokered. Our portfolio, I can tell you after looking at an analysis in the fourth quarter last year, 93.7% brokered. And so brokers are a main line for us, and we certainly take good care of the brokers. But more so, we want to make certain they understand when the tenant comes through the door that as they turn that tenant over on the day of occupancy, the tenant's smiling. The tenant's never looking at them, mad at them for where they put them.
Yeah, that's a good point. All right, we're going to take a short break. When we get back, David, I want to get your insight on that. I mean, you're dealing with these tenants every day. You're seeing the build-outs, and just want to get your insight. And we're also going to look at the investment market. So we have a lot more in store for you. Stay with us. More on the office market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you're a professional provider to the commercial real estate industry, check out the show website. We have a button there called Professional Directory, and it's absolutely free to put your information there. If you listen to the show, you're a smart person, right? Well, today we're exploring the U.S. office market. My guests are Sean O'Reilly with Ernst & Young and David Tennery with Regent Partners. And Dave, before the break, we were talking about companies and their use of space, and like we said, there's been a lot of talk of companies using a lot less space. But what are you seeing on the ground there every day?
Well, I think Sean makes some unfortunately rather good points, and as an owner-operator, we're feeling that. We're realizing that, and it puts real pressure on the owner-operator to provide the space for the tenant and at the same time meet needs infrastructurally within a project. Most projects have some age on them, particularly as you begin to talk about the urban context of where companies are moving. And so parking, you've got a conflict where you need more parking for your tenants, yet most municipalities, particularly in an urban context, are reducing the amount of parking that you're allowed to provide. So you've got stress there. You also have stress on the MEP systems, mechanical, electrical, air conditioning systems. Most systems are designed for 200, give or take, square feet per person. And when you start packing people in at 75, 100, 150 square feet per person, you've got issues you've got to address as well operationally. So a lot of extenuating circumstances you can go through, but those are the immediate things being felt by many owner-operators today. And
that's a big point in leases today, isn't it? If you're a tenant or a landlord, as far as the limit of the number of employees that can utilize that space, right?
That's correct. That's correct. Most leases historically have had anywhere from 200 to 250 square feet per person. Clearly, that's a hotly negotiated item now, and that's one of the things as we talk through leases that tenants really need to be focused on early on. If not addressed in a letter of intent, is understanding what kind of capacity the building can handle with respect to their use.
Right. You don't want to try to go in a building that just can't handle the capacity of the people you want to put in the space per square foot, right? That makes sense. What are you seeing demand-wise in the office sector right now? Are there any certain types of businesses or size of businesses where you're seeing more demand?
Well, and again, back to that point, as Sean says, you've got this conversion of user type within an urban context in many respects. And so law firms, which have traditionally been, Sean, 250 to 400 square feet per person type users, are being replaced by users that are half, if not 40% of that amount of space. And so again, infrastructurally, parking-wise, a lot of things those owner-operators are having to do to address that need and meet that demand.
Okay. And I guess another thing we tend to think about in a recovery is that the smaller tenants start expanding and first, so you might have some smaller leases coming up, and then maybe as we get further in the recovery, some of the bigger tenants start expanding again. And David, in 30 seconds, what are the tenants telling you about the economy and their growth?
Well, they're talking to us through their growth plans, and again, we're seeing a relatively broad-based growth. Small tenants and large tenants alike. Now, when I say large tenants, I'm not talking about tenants doubling their space. I'm still talking about a large tenant right-sizing. For example, we have a tenant in one of our projects that recently went from 40,000 square feet in one building to 52,000 square feet in our building, yet that's a consolidation of roughly 75,000 square feet on a regional basis coming into a central location. So still right-sizing, but certain markets are making it more sense.
Yeah, well, it's great to see more confidence in with corporate users out there. Well, stay tuned. We'll have more intel on the office market. I'm Michael Bull, and this is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We have some incredible shows coming up for you, including a show on lease versus purchase considerations at this point in the cycle, with prices in some cases still well below replacement costs, a good selection of properties in some markets, bargain interest rates, and a recovery part of the cycle. It's an interesting time to consider buying property for your business. Don't miss a show of special interest for you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today we're exploring the U.S. office market with Sean O'Reilly with Ernst & Young and David Tennery with Regent Partners. And guys, I'd like to turn the discussions to investment market, and let's talk about distress to start off with. What do you see for distressed real estate opportunities? And David, at Regent Partners, you guys have been actively buying, and I assume you're still actively buying. What do you see out there for distress and maybe value add opportunities?
Well, the point Sean makes regarding distress versus value add has been, I would say, it used to be a fine line. In the last 3 years, it's been a chasm. And that chasm is closing. And I think wisely, many of the banks, many of the servicers that took these assets back or helped nurse along a sponsorship have done a tremendous job in most markets of really nursing it along, throwing a little bit of additional capex into TI, commissions, and other things required to get a building relatively stable, and now we'll take those buildings to the market. So my sense is the second half of 2013 will be more of a watch and see where some of those assets evolve to. And in 14, I would imagine we'll begin to see again some good opportunistic value add buys. One thing I'll slice out is that interest rate hedge and that interest rate question. So hopefully Walter's correct in the first segment that we don't see any additional big pops in the interest rate, because the interest rate current standards are really allowing a lot of the owners that are marginally holding on to assets to hold on to those assets. When debt costs start going up, then again, that'll be where you find that fine line between distress and value add, and the art of our buy in the coming year is going to be just that success, finding that fine line and then buying at the right time.
That's interesting. So what are you seeing related to pricing and demand for investment properties and cap rates right now as you're out there in the marketplace?
There is still, without question, we hear it anecdotally, but we see it for real. There is still, I don't want to say an abundance, but certainly a healthy amount of capital available on the equity side, and growing more so on the mezz side now. So you're starting to see debt, equity, capital all coming together, and again pairing to create debt capital stacks that will allow for effective acquisition cost on value add plays. But again, as we've all talked about this today, it is very critical that the asset be well positioned, well placed, and look for the future. If you don't have the right story for an asset, I don't care what it is price per pound, it's going to be difficult to get it financed.
Okay. And David, what are you guys looking to acquire right now?
Again, on the office side, we're looking at acquisition opportunities, typically of some scale, again, more of an urban or certainly close in suburban context. We do an awful lot of hotel development work, and so the opportunity right now for acquisition on the hotel sector, repositioning, has been strong. And we've been knocking wood, as I say it, pretty successfully even through the downturn with our high-end mixed-use developments that have high-end condo features. And we're even seeing a strong enough recovery, particularly in the single-envelope mixed-use projects of scale that are probably topped by condos with the great views and great amenity package and all those things, moving forward again. And so development is still a bit off. We still have in every one of our markets, and I think most markets U.S.-wise, with very few exceptions, an awful lot of distance between rate, where rate has to get to justify new development, and rate growth. And so, again, value-add investment, I think, is going to be a strong play in 2014.
Well, I think interest rates are a key point to talk about in the office market, and we'll get to that after the break, so stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We're talking about the U.S. office market with Sean O'Reilly and David Tennery. And David, another factor that's affecting office performance and the investment sales world as well is the lack of new construction. What do you see there for new construction levels and how that might affect the sector?
Look, new construction is going to stay nominal. Again, what's interesting about this last recovery that we're in now is that you didn't see the assets being dumped on the market through an RTC vehicle the way you did back in the 90s. And so as a result, servicers, banks, institutions held on. They were smarter. The result has been that your well-positioned land for your next cycle of development just didn't drop in price. So that combined with the fact that construction industry thinned out so much, and so your pricing is relatively high right now for construction, means that in most markets you've got to have between $5 and $7 plus per square foot of rent growth before you can justify new development of speculation of any sort whatsoever. So to me, that tells us from an investment perspective and an ownership perspective, we are in, during this recovery that Sean described, some period that we haven't experienced in a long time of sustained rate growth.
Well, that's interesting. So with a lack of new construction, you're talking about maybe we will see that rate growth. And do you have a tip for landlords maybe?
I do, landlords and owners. And I think to follow up on what Sean just said, pay a fee if you can. If a lender will let you pay a fee, and most of them are happy to take your money at any given closing to try to fix that fee or make that loan assumable, then it's probably worthwhile given the likelihood of interest rate growth. That said, to landlords, owners, institutional investors, make certain right now you're taking the steps to mitigate your lease value issues that can cost down the road. For example, it's time to get rid of all these contraction options that became so commonplace in the last 2 years of a down cycle. It's time to get rid of all these early termination options that tenants had, and certainly it's time to adjust the issue of capping what renewal rates can look like as a percentage of any prevailing market.
All right, great tip. I appreciate you guys being on the show today. Thank you.
Thank you, Michael.
Next week, we'll look at retail property performance and the retail investment market, so be sure and join us next week. Well, thanks for joining us today. I'm Michael Bull, and this is the Commercial Real Estate Show. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by your friends at Bull Realty, France Media, Atlanta Office Liquidators, and Wiseman, Nowak, Curry, and Wilco. For more information about these companies or to access additional show podcasts, videos, or blogs, visit commercialrealestateshow.com.